This is Budgeting 101 with Joni Kearn.
So reverse mortgages, in a nutshell, they're called HECMs, which is home equity conversion mortgages or reverse mortgages. What they are essentially is a mortgage on your home that pays you instead of you paying the bank. Okay? So I have a list of, there's a nice little table right on the front page that, for those of you that stole handouts before, you probably read those. There was this man and this boy. There's a really nice table of pros and cons, and as we go to the following pages, it does address all of those. Now, my history, well, amongst truck driving and everything else I've done, I wrote mortgages for a long time. And so I consider myself no longer an expert because things have changed, but I still am incredibly knowledgeable when it comes to mortgages. Reverse mortgages were just hitting the marketplace when I was still writing mortgages. So it's been about 10 years, 12 years, something like that, when I first heard about them and they started to get widespread attention. The rest of the pages talk about the pros and the cons, and we're just going to kind of go through these and talk about what each one means. As always, if you have any questions as we go through, just please speak up and ask them. The first one, the federal government regulates reverse mortgages. I read that and I went, that's a con. It's kind of a pro, but it's actually kind of both. We are, as a society, sick of federal regulations, correct? We all think there's not enough, right? We'd like to see more. We'd like to see more government. So to think of a reverse mortgage as very heavily regulated, as is all of the mortgage industry, is kind of disheartening. The reason why I think it's a good thing is that regardless of the fact that you have to jump through a magnitude of hoops to get one of these, and the government looks at them very, very closely, what it means to you is that you are in a mortgage that is protected. Okay? So you can use this equity comfortably, knowing that you were well taken care of. And not everyone can do reverse mortgages. Good morning. Not all lenders can do reverse mortgages. When I was writing mortgages, I couldn't write them. I had to go through a company that could write them. Okay? And they're FHA. Do we all know what an FHA mortgage is? It's the Federal Housing Authority. And they're very strict mortgages. It's not just for first-time home buyers, but they have a low down payment, very heavily regulated. House has to meet certain specifications. And this is an FHA program. So it's a government-insured program, which is good news for all of us in our estates, and I will get there in a minute. You have to have enough equity in your home. They will pay off your existing mortgage if you have one. They will also require that you have enough equity in your home to be able to withdraw some cash. So if you're almost at 100%, it's not going to work. Many senior citizens own their homes free and clear. How many of us own our homes free and clear? Good for you. I mean, it's those last 12 payments that are the longest and the hardest and the best, because I'll tell you what, when you're done, you're like, whew. So you do have to have quite a bit of equity in your home. The more equity you have in your home, the more cash you have access to. Reverse mortgages become the first lien on your property. You can have I don't know, you can have as many mortgages on your home as a bank will allow you to have. 2 is the norm. I have seen 3 and 4. If you put windows throughout your house and you finance them, they often will put a lien, which it essentially is a mortgage, because if you don't pay, they can start the foreclosure process, right? So they do, reverse mortgages have a requirement that they have to be the first lien. So they have precedence over anything else. So they pay off any existing mortgages that you have. They also cap the amount of the loan at, lots of them are at about 80% of your home's mortgage. So again, if you owe 70 or 75% of your home's mortgage, you're not going to have any equity to be able to get back out. And the loan to value ratio, of course, is one of the government regulations. And I think it's right about 80% because they need to stay protected as a lien holder. So you have a cap on how much money you can get out.
Do they pay you up front right away for the whole thing, or do they just pay you monthly?
You have options,
Oh, I see.
actually. And that's under pros. We'll get there.
Okay.
All right? Not all properties qualify. Mobile homes don't qualify. Mobile homes are considered autos. Did you guys know that? Mobile homes, because they are mobile and can be taken off the foundation, hooked up to a trailer with the trailer hitch that comes on them, and driven down the road, are considered autos.
What about manufactured houses, then? Would that be the same?
Um,
Like a regular house, but it's, you take it apart and hook it.
Essentially, pre-built homes fall into 2 categories. They fall into manufactured and they fall into modular. Okay? Modular homes are the ones that come in pieces. Whether they come in walls and rafters and those kinds of pieces, or whether they come in halves and you essentially end up with a double wide, those are modular homes. Those are real homes. And they're built to better specs than our stick-built homes that most of us live in, by the way, which is pretty cool. A manufactured home is what is considered a single-wide trailer home or a single-wide mobile home, and those are the ones that fall under auto. Does that make sense?
Well, what about a manufactured house that's a double wide that's put together?
It-
Would that be the same thing as a single wide?
No. You have to be able, in order for it to be considered a mobile home, the rule of thumb essentially is, if it comes on a trailer, they have to take it off the trailer to put it on your land. It's a modular. If it comes on its own trailer and all they have to do is unhook it as if you're hauling a regular little trailer, that's a mobile and manufactured.
I've got a mobile home, and on those advertisements they have on TV, there's 2 different ads for the reverse mortgage. The one with Henry Winkler is if you own a home. The one with the ex-senator, you call that number, and it's for mobile homes. You can get one for a mobile home also, according to him. When I called the number, they told me the only reason I didn't qualify is because I didn't have enough equity in my mobile home.
That's a surprise, because the information that I have read said mobile homes aren't, but maybe my information is wrong or old. So,
This is what I called the number, and that's what they told me. I didn't have enough equity in my home to qualify.
the rule of thumb is that mobile homes depreciate rather than appreciate, and that would be the problem with them. So that's interesting. There you go. Mobile homes qualify. Some condominiums, they say, won't qualify. And homes that are not FHA approved. So if they need a lot of work, deferred maintenance, if they need a lot of work in order to qualify, you need to be FHA qualified, because FHA will go through, it's an entirely different appraisal. They will look at your porch and make sure that it's solid. They look at how much space there is between the ground and your step up. So if you have a home that one of your outside doors doesn't have steps, they're going to make you put steps on. It's that kind of thing. The windows have to be in good shape, that kind of stuff. Okay?
So they come and inspect
It's an appraisal and an inspection. FHA appraisals are a whole lot tougher. You know, when I was writing mortgages, I would find out about the house to make sure that we could do an FHA loan. My brother got an FHA loan. I wrote the loan. He had to go out and buy a bunch of cement block and build steps down from one of his outside doors because it was like a 4-foot drop. And he had taken off the steps that were there, and he said, "You're kidding me, we don't use it. It stays locked. It's blocked off from the inside." I said, "I don't care. It has to be." And he did. He went out and bought a bunch of cement blocks.
Some people put their mobile home on a foundation. Would that qualify?
This gentleman is saying mobile homes qualify. So
If it's a 1979 or newer, if it's older than that, you don't qualify.
there you go. If you put it on a foundation, it is still considered a mobile home because you can still lift it off the foundation, hook it up to a ball and hitch, and drive it away. Okay? So that is still considered a mobile home, but if it's a 79 or newer and you've got enough equity, and mobile homes are kind of funny animals because if I put one on my property, I've got 40 acres, so I have appreciable acreage with a depreciating home. So it's kind of a different animal. If you have a mobile home in a mobile home park, maybe that would be different.
Strange thing about mobile homes is that yes, they are movable. But if you remove the axles with the wheels, it's no longer movable. Now it's a permanent foundation. It's just a technicality that's really stupid.
I
to
know.
understand it.
And most people remove that kind of stuff. I'm not so, yeah and no. It depends on who you're talking to. The argument is you can still lift it up and put the wheels back on. The foundation of the mobile home itself is steel beams. So you could pick it up, put the wheels back on, and off you go. I mean, it used to be if you took the trailer hitch off, you're good to go. Yeah.
It's all little technicalities that are ridiculous.
Yeah. Yep. A reverse mortgage is secured by placing a lien on your home, and we talked about that. It becomes the first mortgage. So because you're taking out equity, they want to be the first lien holder. You have to keep the home insured and maintained. So you have to keep it. You have to keep your homeowner's insurance on it. You have to keep all of the upkeep on it, just like you would for your regular mortgage or your regular insurance. Because when they go to, when they own the home, when the day comes, when they sell the home, then they need to make sure that it's maintained enough that they can get their mortgage out of the property. Okay? Pros. No monthly mortgage payments are required on the loan. Loan proceeds are non-taxable. So we're going to talk about those two kind of in one lump sum. When I do my investment talks here, I talk about making sure that as you invest your money, that you have some when you withdraw it is taxable and some is not, because what it does is it lowers your tax burden, right? So if you take out $2,000 a month and $1,000 is non-taxable and $1,000 is taxable, when you file your taxes, you have $12,000 in taxable income, not $24,000. Does that make sense? One of the really neat things about reverse mortgages is that what you take out of it is non-taxable. It's home equity. So if you went and got a loan from a bank and they gave you a cashier's check, that's not income when you file taxes next year. Reverse mortgages are the exact same thing. So you can protect your tax base and still have extra money to be able to live on. Okay? You can continue to live in your home for as long as you wish. One of the myths with reverse mortgages is that if I get a reverse mortgage on my home, I've lost ownership. That is not true. You still are 100% owner. They just have a lien on it. My mortgage holder, if I default on my mortgage, now they own the house. But until I default on my mortgage, I own the house, right? Reverse mortgages are the exact same thing. You retain ownership of the property, and it is the way these work is that the reverse mortgage does not need to be paid back until you no longer live in the house. So if you end up in a long-term care facility for longer than a year and it's 12 months, you no longer are considered in the home. If you are married and one spouse dies, you're still good because you still retain ownership in the home. So it's normally until death, but if you end up in a long-term care facility for longer than 12 months, you are now considered out of it, and they're going to ask for the loan to be repaid. At which point you can just write out a check, or you can sell your home, okay? You continue to live in your home for as long as you wish. You also need to do upkeep and maintenance. Mortgage lenders, actually, whether we know it or not, drive by our homes every once in a while just to make sure that they haven't burned to the ground. We don't have any huge holes in the wall. The roof is still in good shape, because they can come back to us and say, our lien is based on whether or not your home is resellable. They're going to do the same thing with a reverse mortgage. You keep title. We just talked about that. You're protected from owing more than the value of your loan when it's sold. Another one of the myths is that if the market depreciates and your home loses value, then they will take the rest of your assets in order to pay for it. Not true. They can only take the home. So if we hit a market slump and you lost 20% of the value in your home, like we did in 2008-ish, then they take the loss. They don't come back to you if you no longer live in the home, or your heirs if it becomes estate property, to pay off the rest of the loan. They simply accept the house on its terms, which, by the way, is why they don't allow you to go up to 100% value of their home. They need to protect their interests, right? And as you withdraw money, with mortgages, if I own $100,000 on my house, every month I pay the interest on $100,000. The next month I own $99,500. I pay interest on the $99,500. That's a simple interest. We're all familiar with that. If I have a reverse mortgage and I owe $10,000, I'm going to pay on the $10,000. If the next month I owe $10,500, my interest is on the $10,500. Does that make sense? So as you withdraw the equity, and because you're not required to make payments, your amount of interest is going to continue to go up. Okay? The loan is non-recourse, which again means that if you have assets outside of your home, when the home is sold, either because it's part of the estate or someone else takes, if you want to leave the home to your kids, and you know that you owe a mortgage, but that it's less than the home's value, then they can simply pay off the loan by taking out a mortgage. So it doesn't mean you lose. It's not as if the day after you die, there's going to be people standing at the door and they're going to lock everything down and nobody can get anything out of it. It's not the way that works. So it's someone else. They can sell the home. They can sell the home to one of your heirs if you have kids or grandkids or whatever that you want to leave the house to. I have a very good friend that his grandparents left their paid off home to him. His aunts and uncles had a fit about that as part of the will, so he ended up paying off their share by getting a mortgage on his home. Same thing with one of these. Okay? Government regulations allow you to make informed decisions and protect your home. If you go into the reverse mortgage process, before you truly begin it, they are going to require that you sit down or talk on the phone with a reverse mortgage counselor so that all your questions are answered. Reverse mortgages are completely explained to you. You understand both the pros and the cons. You don't ever have to make a payment on the mortgage balance that you're due. So you can, and there's no payment penalty. So if you win the lottery, I mean, you can pay off the reverse mortgage if you want to without any penalty, but you don't ever have to make a payment, which is one of the really nice things about it. I think the reason that I like reverse mortgages so much is because as we age, the amount of our health care skyrockets. We are normally on fixed income, and as all of you know, Social Security did not get an increase last year, nor did veterans benefits, because my husband is a 100% disabled veteran. I mean, there was no cost of living increase. So as our health care costs skyrocket, as our prescriptions skyrocket, as the cost of food. John told me, now he left for Florida again yesterday, so I got to go back to a grocery store. I'm really bummed. He tells me that the cost of groceries have just skyrocketed in the last year. Is this true? Yeah, I don't know. The reverse mortgages, I think, are a phenomenal way to be able to hedge your bets, to be able to prepare yourself. You can get, and I didn't get the question answered soon enough, you could get a reverse mortgage in a line of credit that you use as you need, or you can get monthly payments so that you have a fixed amount that you're bringing in every single month. If you get a reverse mortgage to make sure that you are taken care of if an emergency happens, most of us don't have $6,000, $7,000, $8,000 just laying around in a cookie jar to replace the furnace when it goes out. So we end up either financing it. That would be a nice thing for a reverse mortgage line of credit to take care of. If you're falling short on monthly income because of your prescriptions or because of living expenses, then a fixed payment back to you would be a really nice thing to have. I just think it's a great way. As senior citizens, we worked hard for most of our life. You worked hard as kids, helping take care of the farm, helping take care of the house, helping do the land, helping do all of that kind of stuff. You worked hard as adults, raising kids at jobs, 1, 2, 3 jobs, whatever you needed to have to make sure your kids are raised, thinking that, and you could correct me if I'm wrong, thinking that when you retired, you were going to be able to enjoy yourself, right? Many of us can't. We can't do the things that we looked forward to doing all of our life because our budget is too tight in order to do that. If you have the ability to do something like a reverse mortgage, then you have the ability to be able to do some of the things that you've always wanted to do. And whether it's a dream vacation that you've always wanted to do, or a winter in Florida, or whatever else, whether it's month-to-month living expenses, being able to stay on your own, you can use a reverse mortgage to pay maintenance on your house. I mean, you can do that as well, to pay the insurance and the taxes and everything else you need to do. So it's a really nice way of increasing our income. What has to be understood is that when you no longer are in the house, and if you were in a permanent care, long-term care facility for more than a year, you'd probably choose to sell your home anyway. But you have to understand that there's a lien on it. So if you've always dreamed of leaving your home to your kids or grandkids or whoever it is, then making sure that they understood there was a mortgage on the house that they would need to refinance. If you're still giving them a gift of some equity in a home, they're still way ahead of the game. But that's kind of one of those personal choices. I just think as we age, personally, I think as I age, I would prefer to have the money I needed Not necessarily everything I wanted, but certainly the money I needed to live on so that I wasn't eating a can of beets for lunch instead of being able to have, say, a peanut butter and jelly sandwich. I would rather do that than leave a home free and clear to my estate. And most people that we would leave our home to would agree with you. I mean, they would rather have you use the equity to be able to do some of the things you want to do, whether it's a new car. My mom drives a 1988 Honda, and if she put on more than 1,000 miles a year, the car wouldn't work, and she still is putting money into a car. Now, she lives in a senior housing apartment, so she certainly doesn't have the ability to do a reverse mortgage. But it is, I mean, that would be one of those things that if she still lived in her home and it was paid off, that's one of the things I would be encouraging her to do so that she had more income to do the things that she wanted to do while she was here. Questions? Yes?
I heard somebody talking the other day that when you're, say you go to Park Vista, they freeze all your assets. And then, I don't know at what time they sell the assets in order to pay your obligation for Park Vista. So I guess my question would be, with the reverse mortgage, does then Park Vista become a second lien holder, or it can get kind of messy, I think?
I don't know that I have the answer to that question. Here's what I do know. If you could write out a check to Park Vista every month, they're not going to freeze your assets.
Right. My mother went there. They haven't frozen her assets.
When it comes to Medicaid, and you are needing Medicaid to pay, then they have rights. I don't know they can freeze it, but they certainly have rights.
And I'm not sure that Park Vista takes Medicaid. They didn't for a while, and then they were talking about going back to accepting it again. So I don't know where they're at in that process.
Medicaid is a pain in the butt. You are only allowed X amount of assets. You know, where Medicare doesn't have that cap, Medicaid does. That's what the Medicaid program is built for, is to take care of people who don't have the assets to take care of themselves. That becomes a huge issue. It's entirely possible that a place like Park Vista, because they can take people that are unable to pay but absolutely unable to care for themselves in their own home anymore, it's possible that some of that can come into play. When my sister-in-law put her mom into a nursing home for care, she owned a home. And what Carolyn could do with that home was fairly heavily regulated. So she needed to go through all of this. Her mom was able to, the agreement that they had was that if my sister-in-law, my brother was alive at the time, had the ability to be able to rent out the home and kept it rented out, then the rent from that property minus any maintenance taxes and insurance went back to the facility. Otherwise, they had to sell the house and they had to just write out checks, and they wrote out checks anyway. And then shortly before they died, getting her on Medicaid was a 2-year-long process with a lawyer. And they finally got her on Medicaid about, 4 months before she passed or something like that. But that became a pretty difficult thing to work through. And she was in a high-end nursing home. She wasn't in one of the Medicare-approved state facilities or local government facilities. So that could have made a difference with that too.
Does interest accumulate on that kind of a loan?
Pardon me?
Does interest accumulate on that kind of loan?
Yes. Which is one of the reasons that they're going to cap you at how much you can take out. It's based on age and how long how long a lifespan you're expected to live. So if you take it out at 62, it's probably going to be a little bit lower cap than if you take it out at 80, because the chances of you living a longer life are far greater. So they do figure all of that in the loan. How much of this interest is going to accumulate over the life of the loan? You know, how long are you going to have the loan in all probability?
So, I guess I'm really confused. Why do people do this? And it's just because you want extra money to live on? And I mean, we've owned our home for over 10 years, and I'm like, why would I want to start paying payments again?
It allows people who don't have enough monthly income to be able to do it without going into further debt or having to make payments.
You're paying again for your own home. You're buying it again? I mean, sort of.
You're taking a mortgage out on it.
Again.
Mm-hmm.
Yeah, you're paying twice for it. Sort of.
Sort of. I mean, your estate pays for it with a reverse mortgage, or you do if you decide to sell your home. There are lots of us in a position where we simply don't have enough budget to be able to do the things we need to do. And then taxes come once a year. And then insurance comes once a year. And we end up so strapped that we're choosing between food and taxes. Reverse mortgages allow us to be able to live a comfortable and pay for our necessities. Here's the other thing, is if you have a reverse mortgage and you have the ability to make the payments if you want to, then it gives you the option of being able to skip the payments. So let's say, my car's a Jetta, 2006 Jetta, and we put better than $2,000 into a wiring harness, and I got a great deal. If I was on a very limited income and just barely making ends meet, then I have the option of charging it and making payments, or not getting it fixed and being without a car. If I have a reverse mortgage, I can pay cash, essentially, for it. I'm not paying charge card interest rates, and I don't have to pay it back if I am unable to. Okay? So then I still retain my vehicle. And there are lots of people that are on such a tight budget that they're not able to stay in the apartments, their homes, because they need to get into a senior housing based on your income kind of apartment payment, which is how my mom ended up in the place that she is in. I think she'd have a nicer apartment if she wasn't on such a tight budget and could afford to just pay full rent. I think she'd be in a nicer place.
What if you live longer than what they expect? I mean, like some people live for 110 or better. Now, you need to take the out then, or what do you?
Because of the way the mortgage is written, you get to live in your house as long as you want. So if you live to be 110, then, you know, if it was a line of credit, I'm not sure if they would cap you. You have X amount of money to use, okay? If you're guaranteed payments, you're probably guaranteed payments up to X amount, say the 80% loan to value that I was talking about. So after that, you would not have the ability to withdraw that money anymore. So let's say you come from a line that lives forever, which is pretty much my family, both sides. I mean, I've lost 3 brothers and they were very young, but my uncles and aunts lived to be 190, 193, something. I mean, they live forever, which is really good because that's a genetic kind of thing. So I expect to live a very long life. So if I knew I had access to this amount of money and that was it, I would spend what I had. I would do a line of credit so I had access to the money if I needed it. but I would live frugally thinking, okay, I'm probably going to live to be 110 and I want to make sure I have it as I age. Knowing that my healthcare costs are going to rise the older I get, the higher they're going to get in all probability, I'm going to want to make sure that I prepare for that eventuality. Kind of like having a savings account. You do the same thing. If you have a savings account to do a furnace, you don't go out to lunch every single day at a $20 a meal restaurant without thinking about, I'm spending my furnace money. Heat, food. You know what I mean?
I got a question for you. Supposing you take out a reverse mortgage, say for $100,000, if that's they allot you, because that's the equity of having your home.
Mm-hmm.
And now you decide you use up about 30,000 of that 100,000.
Uh-huh.
Now you decide you want to stop.
Uh-huh.
How does that work?
Well, you can do one of two things. If you're on payments every single month, then you bank the payments. If you're with a home equity line of credit, you write the check out whenever you need to access the cash. The fees on reverse mortgages tend to be pretty high. FHA charges 1.5% of the amount of mortgage up front. So if you're able to access $60,000 in equity, but you actually have with all of the fees $100,000, right? They take that into account. Then you're going to pay FHA fees, that 1.5% up front of $1,500. They also require PMI, which is mortgage insurance on your loan, because that's what covers the additional money if your house is only worth 80, but you live to be 110 and you actually owe $100,000 on your home. That's what mortgage insurance, FHA insurance is. That's what it kind of is, and that's a little bit higher. You can also pay fees up front. You're going to have appraisal fees, closing costs, all of that. So they do say that your fees tend to be higher on these mortgages. FHA mortgages are more expensive mortgages to write. You have to weigh the pros and cons. FHA will allow you to go into a house with as little as 3% down, and the interest rates are lower. So you pay more in upfront costs. People who are on a tight budget and want to buy a home, if you can roll those costs into the mortgage, are really happy to do that, right? That makes sense. It makes sense to them with their own budget and their own income. So reverse mortgages tend to have, because they're FHA backed mortgages, you're still going to pay higher fees. So if they give you a $100,000 line of credit, they're going to take those fees out of that right up front, if that makes sense.
In other words, if you only use 30,000 of that 100,000, and you want to stop the reverse mortgage payment, then you would pay on that $30,000, and they would take plus whatever the interest would be on that 30,000.
You would pay the interest on $30,000. With a line of credit, if I take out a line of credit for $100,000 on my home from the bank, the only difference, the biggest difference between these two mortgages, let's say I go to First National Bank and I take out a $100,000 loan. I'm going to pay all of the closing costs. Anything that is percentage, I'm going to pay that on a $100,000 loan, because that's the line of credit I have access to, right? But if I go 10 years without actually using it, I will pay interest only on the closing costs that were associated with the loan, not anything else. So it's the same way with this mortgage. You're going to pay the closing costs based on the amount of the mortgage that you want. If you want to freeze it, if you only want to spend $30,000, remember you're not making any payments. So you can either just not spend any more than the $30,000. You could make payments on the loan, which some people choose to do to make sure that you have equity for later. So you can make payments on it and pay that down, or you can pay it off in full. Once you've paid it off in full, just like your regular home, when you paid it off in 12 months, you have your mortgage free. You have all the equity. Did that answer your question? Yes.
Okay, so my in-laws have their own home, and I think it's paid for, and they are getting scared because their money is, they're using a little bit more money than what's coming market isn't good and you can't get your home sold, how does that work? Or, after they pass away or whatever. What happens in next?
First question. There are never, never, never any payments required on a reverse mortgage. Even if you go over your home's value, never make a payment on the first mortgage. So, and this is a really good, when you asked why on earth would anyone do this, this is a great example. I have a future to look at, and by the way, this isn't based on your health like some, like the life insurances or whatever are, but I'm looking forward to many more years. My mother-in-law, when she sold her house in Menasha, I think she had $14,000 cash out. She budgeted that $14,000 for the Kearn family lives forever too. She budgeted that $14,000 for many years, and I think it's gone now, but that's what she used it for. So once that money was gone, now she was back down to the regular income. So if you're looking at a point where if I end up in the hospital, we all know that they only charge like $100 for intensive care, right? I mean, I think when I had my appendix taken out, I don't know that it was a $200 bill, and that was emergency surgery. Today, that's $50,000 or $60,000. So if you don't have insurance that's going to pay 100% of that bill, you're in trouble. So you can pull money out of that, either with monthly payments or with a line of credit so that you can be prepared. It's the kind of thing, if I was sitting down meeting with them and that's all the information I got, I would say if your fear is for the future, set it up on a line of credit so that you have access to the money if you need it. You don't get a check every single month because right now you're living comfortably exactly the way you want to be without that extra income.
But they're not, so in that case it would be, what? I mean, they wouldn't do line of credit,
They would do monthly payments. Just like you have a mortgage payment now where you have to write out a check on the first of the month for however much your mortgage is, $500. You need to write a check out on the first of the month. With a reverse mortgage, they automatically deposit $500 a month into your account. Okay? Second part of that question was, what happens when I pass away or no longer live in the house for 12 months or more? It's not a repossession in that it goes to the bank. Once you no longer own your home, once you're no longer living there or you pass away, the mortgage company now has full lien on the house. Part of the contract for the reverse mortgage says that when you no longer live in the home needs to be sold. If I sell it to my heirs as part of the estate, I have a grandson named Ben who has always wanted my home. You can sell it to him as part of the estate. Your gift to him is the equity that's left in the home. He needs to mortgage it. It's not as if they come in, put locks on all of your doors and say, yeah, it's mine now. And they want, if your home is worth $150,000 and you end up only owing $50,000, they're only going to ask for the $50,000. The $100,000 is either cash that goes into your estate for your heirs, or you can gift it as equity in the home to whoever you want to give the house to.
okay, so there is, if there's still equity left that goes into the estate.
They cannot, reverse mortgages cannot, because they're very heavily regulated, they cannot take any value out of your home. They're going to ask for it to be sold for fair market value. So if your home is worth $500,000 and you want to sell it for $150,000 and you owe $160,000, that's not going to be allowed. Okay? They're going to ask you to sell it for fair market value. But when you sell it for $500,000, then they will take what you owe of $160,000 and $340 goes wherever you wanted it to go in the first place.
Okay, so if the kids, if nobody wants if we don't want their house, nobody wants their house, then we would put their house up for sale?
As part of the estate,
And
just like it would normally work.
then if that doesn't sell for 3 years, 4 years?
Doesn't sell for
it's
3
on
or
the
4 years.
market, I mean, it's okay just as long as it's for sale?
It has to be sold. They won't force payments on it until it is sold. Never a payment on a reverse mortgage. Never. So let's say we take this $300,000 home, okay? When you pass, you owe $150,000 on it. You didn't take out the entire thing. You owe $150,000. So we know that the first mortgage, just like my first mortgage, if I die, my mortgage company is going to force the sale of my home because I have a lien on it and the lien needs to be paid. No difference here. What are they going to do? They can continue to lower the cost of the home. So if it doesn't sell in the first 6 months, they'll lower it $10,000. If it doesn't sell in the second 6 months, they'll lower it another $20,000. I mean, you're gonna keep lowering the price of it. They're still not going to. All you're going to do is pay off the lien when the house gets sold. As far as the payments, never a payment on a reverse mortgage balance.
If the parties die, who then pays, and the house isn't sold for 3 years, who pays the insurance and the taxes?
The estate.
The estate, in other words, she would have to pay.
The estate would pay it.
And then,
Because if you don't pay your taxes, what happens? I mean, the city or the county or whoever you're paying taxes to is going to come after you and say they're either going to put a lien on your property or they're going to start foreclosure proceedings. They usually wait 5 years. But just as with any estate, that's exactly what happens. So if there's any money in the estate and the estate is handled by a lawyer, lawyers keep part of the money aside to pay anything that needs to be paid. Maintenance on a home, heating bills in the winter because you would have to heat it, insurances, taxes, their fees. I mean, everything is, they bank money to make sure that those are all paid.
There's no escrow built into these reverse mortgage loans.
Nope, you're responsible for all of that yourself. You continue to get money without having to pay it back. You look at me like you think this is way too good to be true.
They can put that money in a bank every month and let it draw interest and live off it.
I'll tell you what. This is the investment side of me. Interest rates are what today? 3.5%? Ish. That's going to change because as interest rates on mortgages go up, interest rates on savings accounts are going to go up. Remember, a bank has to pay out enough interest to get money in the bank so they can loan it out at an interest rate, right? So if cars are at 5% interest rate or homes are at 5%, banks need money in order to loan it out, so they're going to be paying 7%. In the late 80s, when home interest rates, I mean, late 70s, at least. Most people bought homes on land contracts because they couldn't afford a home with the interest rates, and some of them were as high as the mid-20s. In the late 70s, a friend of mine, Mike, was handling his mother's estate, and he saw this coming, and he could get like 30-year bonds through the government for 18%. Okay, so she already owned her home, so let's say she's paying 3% or 5% or 6% on her mortgage. Now he's making 18%. He put every dime of hers into that. For 30 years, they couldn't do anything. They couldn't do anything. So she made money. So if I'm at 3.5% on my reverse mortgage and they're going to cut me a check, or I have a line of credit, and all of a sudden I can get a bond at 10%, then I'm going to withdraw as much as I can, and I'm going to buy a bond because I'm 5-6% ahead of the game.
When I bought my place, we bought it on a land contract. We went through the attorneys and signed the contract. It's at 3% interest as long as I don't default. If I default, it goes all the way up to 12% interest. And that would be the penalty for defaulting on your payment.
So today, it makes more sense to pay a mortgage off than it does to put the money in the bank. Because if you can put a decent amount of money in the bank and you can get 2%, you're still behind 1%. But if I could put money away at 3.5% or 4%, then I'm better off keeping my mortgage where it is and putting all of my money in a bank. Also keep in mind that once you pay off the mortgage, it's going to be great for him to have title to the house, but he now no longer gets the tax credit when he files his taxes in the spring. I rewrote a mortgage for people, and
My taxes are not high enough for me to be underneath the homestead.
if I refinanced a home for a couple one time. It saved them like $400 or $500 a month in their payments. They loved it. And I did this in, I don't know, the summer or something. They stopped by my office like the next April and they said, love the interest rate. Hate how much less we got back on our tax return this year because you get a percentage of the interest that you pay on your home. So you always have to take a look at, and this again is the investment side of me, you always have to take a look at if overpaying my mortgage, what's the difference? Because let's say I get 3%, let's say I pay 3% on my mortgage and I have 3% I could get from a savings account. Which one is going to yield you more money? No, because if you put that 3% on your mortgage, you now have less of a tax credit. You're actually ahead by putting it into an investment. And that has to be looked at when you start thinking about, I have some extra money every month, what do I want to do with it? So I'll pay off anything and everything before I pay off my mortgage. I'll leave that payment right where it's at.
Okay, I might not be understanding this, but you say that interest, who's paying that interest if you're not making any, let's say, who's paying that interest if my in-laws aren't making any payments? That's just rolled into the lien and you pay more in the end, whoever, okay. All right.
No payments. Yes. And that's all taken into account when they decide how much money you can take out of the house. This isn't, let's say you got a $30,000 line of credit and you live to be 120 years old. This is not a guaranteed lifetime income annuity. This is, you get X amount of money and then you're done getting money. And they figure the interest in that. They figure the market value in that. They figure everything in that. Now, when we talk about who gets the home when your in-laws pass, you also have to keep in mind that let's say it's a $300,000 home and they got a reverse mortgage. Your house's value sinks because the mortgage falls apart again. It'll happen again someday. So now your $300,000 home is only worth $195,000, but they wrote a mortgage and you owe $250,000. The extra $50,000 is part of the cost of doing business for the reverse mortgage lender. That extra money it's a non-recourse loan. They take what they owe, or as close as they can get to it. None of your other assets are affected. So if your in-laws have $100,000 in the bank, and when they pass, they owe $50,000 more on their home because of a reverse mortgage than it's worth, the reverse mortgage doesn't get $50,000 of the other assets. They get what the house sells for. The other $50,000 is a write-off. Hence the reason they're charging interest on it. And FHA mortgages at 1.5 up front is part of the whole guarantee of them being able to keep the program alive. I mean, that's just the way that has always been. Does that make sense to you? Any other questions?